As you manage your fund, it's important to diversify the investments in your portfolio. Risk and return will vary across and within different asset classes. Diversification helps you to manage and take advantage of this variability. So when you think about diversifying, think about a bowl of peas. Each pea pod represents an asset class. You may have one pod for US stocks, one for bonds, and several other pods for other assets such as real estate, venture capital, private equity, hedge funds, etc. Inside each pea pod, you'll see different peas that represent the variation within that asset class. For example, in the pod for US stocks, there are peas for big, medium, and small-sized companies, and companies that are growing more or less rapidly. In the bond pod, there are peas for US bonds, government bonds, various corporate bonds, and foreign bonds. Which pods of peas do you want in your portfolio to keep it balanced? This is a quilt chart. Each column represents an investment year and shows the best performing asset class at the top and the worst performing asset class at the bottom. Take a look at 2008, the year of the Great Recession. The best performer was the Bloomberg Barclays U.S. Aggregate Bond Index, returning 5.24%, a pretty remarkable return for such a bad year. But further down the column is the S&P 500, which was down 37%, as well as other assets that performed even worse than that. These patterns won't persist each and every year. Look at the pivot from 2008 to 2017. The S&P 500, which was down 37% in 2008, returned 7.36% in 2017. And the bond index, which was the best performer in 2008, fell to the bottom of the column, returning just 1.51% in 2017. And that's the point of diversification. In some years, small stocks will do better than big stocks, foreign stocks will do worse than US stocks, and so forth. All of those things vary, and diversifying your portfolio with all types of investments helps you to weather these changes. We can also measure diversification by tracking how assets correlate with each other. Suppose you had asset A and asset B, and they did exactly the same thing at exactly the same time all the time. They would have perfect correlation and have a correlation coefficient of positive 1.0. But would there be any value in holding them both? No. The inverse is two assets that always do the exact opposite at the same time, which carries a correlation coefficient of negative 1.0. It's very hard to find assets that are always negatively correlated, but in an ideal world, that would be nice because you could smooth returns rather than riding everything up and down together. Correlations can vary over time and won't necessarily be the same year to year or month to month. This correlation matrix lists the same commonly held assets along the top and the left. Each asset class has a correlation coefficient of 1.0 when measured against itself, because it will, of course, perfectly correlate with itself. Now let's look at how asset classes correlate with each other. The S&P 500, which measures large cap stocks, has a very high correlation with the Russell 2000, which measures aggressive smaller stocks. The relationship has a correlation coefficient of 0.88. The correlation between the S&P 500 and emerging market stocks is slightly lower at 0.78. Then look at what happens with bonds and treasury bills. Correlations are slightly negative, which implies that stocks and fixed income investments tend to have more opposite performances. This illustrates the concept of diversification. If you own a mix of investments like bonds, US Treasury bills, real estate, etc., these assets will perform differently than stocks. Sometimes better and sometimes worse. They are not perfectly correlated, and that's the purpose of holding all of them. In other words, diversification is another way to manage risk and return.